Hello everyone, welcome to this new video. It's a different style video than I did before the stock analysis. But then I saw these other financial YouTubers do these portfolio updates, and I thought, well, that's fun. It's fun to watch. It's usually when you watch someone make an investment video and even, well, not really advise, but at least give his takes on a certain company, you would want to look at, okay, well, but how is he doing financially? So I want to share my financial portfolio, and so you guys get a bit of an idea about do I really know what I'm talking about or not. So this is the portfolio update of December 2023, and it's the first one of its kind. So the current situation is, well, this is basically my portfolio. That's the video done. You know, stop watching now and see you guys later in the next. No, okay. So first thing I have to disclose is I'm European, so I use euros instead of dollars. But for the American viewers, I have put the dollars next to the euros, so you can kind of, well, you can see that, of course, on the slide yourself. My current situation is a bit cash heavy, as you can see. I have a little bit invested in ETFs, stocks, bonds, and crypto, but and I have a lot in savings. About 2/3 of my entire portfolio is in savings. My total portfolio is about 30,000 euros or dollars. The problem with that is you don't want too much in cash. I'm very lucky now that the interest rates are relatively high, but next year they're predicting that the interest rates are going to drop. Now, of course, a prediction is just a prediction. They predicted in 2023 as well that there would be a major recession and we would all suffer from financial losses and whatnot, but that didn't really happen, did it? So prediction is just a prediction, but I do see it as relatively realistic that eventually the interest rates are going to drop. So I want to eventually drop my savings down a bit, well, quite a bit actually. But I want to go into a lot more detail regarding the ETF, stocks, bonds, and crypto. Here I have all of my exchange traded funds, ETFs in short. I got my little laser pointer so I can point at things, so don't get scared because there is a red dot on your screen. Now these are all relatively new purchases. I purchased these in the last 2 months. They're all doing really well. I purchased these two, by the way, earlier, sooner than these two. These two are really recent purchases, about 2 weeks ago, and these two are, I think, about 2 months ago. So my largest position is the iShares Core S&P 500, which is just an S&P 500 ETF. Purchase free average buy price 448, and current value of per share 453. Total value comes down to this, with a profit of 1%. And then you see the profit in euros and profit in USDs. Now, as you can see already, USD is almost the same as euro. Add about 10% and you get what the price is in USD. I also have a Vanguard S&P 500 fund. Now, why do I have two S&P 500 funds, you might ask, which is a very good question. Now, the reason for that is that the iShares are purchased later than the Vanguard, and the iShares is actually cheaper than the Vanguard one. In addition to that, the iShares one is accumulating, and the Vanguard one is distributing. Now, what does that mean? Distributing means that the dividends this fund pays out, or the companies in this fund pays out, it pays the dividends to me. While the dividends paid in this fund pays is automatically reinvested into the companies or into the fund, basically. So the fund grows quicker, which is something I want. Because normally you would say, okay, well, maybe you would get dividend tax. Well, luckily, for me at least, the Vanguard S&P 500 is located in Ireland, which has a 0% dividend tax. So I don't pay any taxes on it. However, I still get the money and I need to reinvest it, which costs me, first of all, transaction costs. And second of all, it is just a hassle because I get like what? From this fund, I get like €1 a year in dividends. So at that point, why would I want a euro in dividends? I just want it to be automatically reinvested and be put to work. So that's the major reason why I've changed to this one. And then I only have two of this fund, two shares or two funds or whatever. I'm just gonna call it a share from now on. 2 shares. And do I want to sell it? Just these 2 shares? Uh, just because I want to streamline my portfolio? I don't really know. So I'll have to think about that. But for the time being, I'll just keep them, I'll just hold them, and I'll see whatever I do. Also, I have an all-world version. I strayed away from the all-world indexes or indices, and I'll explain that later in the slides because I'll go deeper into it. The kind of makeup of this video, by the way, just so you know, is in the beginning I share my portfolio, then I share my future plans or my ideas, and then I'll give a little bit of theory behind my actions. So just so you know, the reason I've strayed away from the all-world indices is for another reason. I'll explain it later in the video. And I also have a bit of US tech. US tech index. This is basically kind of like the European version of the Nasdaq 100. Okay, this one holds about 60 companies, I believe, so it's a bit smaller, more concentrated than the Nasdaq, but the idea is technically the same. And why I've chosen for a tech sector ETF, I'll explain it later in the video as well. Now, if you go to stocks, hey, there's a stock that seems familiar and another stock that seems familiar. I did 2 videos on these companies for the people that don't know. So if you want to check out these stock analyses, then go ahead and take a look on my channel. I purchased these companies about 2 months ago, I believe now, like 1 month ago. I don't know exactly, but something like that. For the average buy price here, and then the current value per share. As you can see, the Alphabet stock did really well, 7.5% in about a month. That's absolutely very good. That's not terrible at all. Very happy with that. The Alibaba stock is doing a bit less good, but you know, I'm fine with it. 3% down. There's a lot of upside potential still, so I'm perfectly happy. And I bought at a good price. And in addition to that, by the way, Alibaba is also paying out a dividend of about $1 per share. So in January, I'm getting $14. So maybe I'll be able to recoup that loss a bit, even though dividends get subtracted from the share price, so it doesn't really matter that much. But just for the idea, I guess for the ease of mind or the calm mind, I'll be fine with that. But yeah, no, I think Alibaba will hopefully recoup that loss a bit. Something that some people might have noticed is, why do I have such weird tickers? And why do I have everything in euros? Well, that's because I bought these on the German exchange, the German Citra exchange, because I'm European, as I already said. So I want everything that I buy to be noted in euros, because that applies more to me. So that's why I have these weird tickers, because I basically bought the German equivalent. Or like, I don't exactly know how they do it, but I think it's like a tracker. So something like that. But it's basically just the same stock, but on the German exchange. That's why everything is in euros, and the tickers are a bit weird for the American viewers, or even maybe some German viewers, because I do know that even German or European people also buy things directly from the Nasdaq or the NYSE. But I bought it on the German Citra exchange. Bonds, ticker not applicable, even though you do have a ticker for bonds, but it's like a very long ticker, and it's not really that important for you guys, I guess. The name is the NL, so that's Dutch. It's the Dutch government 4% 2037 bond. Amount about 30 or 3,000, as it's noted in bonds, because everything in bonds is times 100, I guess. I don't know, but it's basically 30 bonds. Average buy price was 111%, because that's how bonds work. They have a nominal price of 100, and the buy price is always, or pretty much always, noted in percentages. So it's 111%. I'm paying 11% over nominal value. Current value is 118%. And since the nominal value is 100 euros, I paid 111 euros on average, and the current value is 118 euros on average, making total value 3,552, and profited nearly 10% in a span of 3 months, which is just tremendous. I don't know, this is kind of hard to grasp for myself even, because normally bonds are very boring, but currently bonds are the best performing asset in my portfolio. And when I bought these at 4%, even some of my buds, they told me, dude, why would you even do that? It's 4%. That's a terrible deal. You can just put your money on a savings account and get nearly 5%. And I said, well, yeah, sure, that's now, but these will run till 2037, which is about 15 years. So 15 years of 4% interest. I personally think that's pretty good. And also in three months now, I got profit of 10%, so obviously the markets agree with me. Profit in total in euros, 321 euros currently, or profit in USD is $350. So I'm very happy with this bond pick here, and I'll keep on accumulating a bit for as long as I can, as long as it's interesting. Because of course, if the buy price goes to like 200%, which it has been almost, I think like 5 years ago or whatever, then I'll of course stop investing in this bond because then it's not that interesting anymore. But currently, it's about I'm getting about 3.6%, 3.5% interest on my average buy price. So I think it's perfectly acceptable. Cryptocurrencies. I used to have way more cryptocurrencies. I used to be heavily invested in Chainlink. I think it's half a year ago, I had about 5,000 Chainlink. So you can calculate 5,000 times 6, about 6. I think it was, yeah, $6 was about my average buy price then. I wish I had kept them. I still beat my head over it. I sold them when they were about $7 or whatever. And yeah, that was a terrible deal because now they're about $15 a piece. So yeah, I still beat my head over it. But at the time it was nice profit and I'm happy with it. Whatever. That's also, by the way, why my cash is so much. My savings is so much because I had so much in Chainlink. But not anymore. I've strayed away from cryptocurrencies and I've accepted the stock exchange as my next best friend. But I still have a little bit of Link and a little Bitcoin. I purchased these at about $13.81 for Chainlink, which is about $14 or euros, sorry, and it's about $14.50 and $40,000 or 39,000 euros. 43 that is, by the way. Sorry. As you can see, profit not that much. Euros also not that much because I've only invested about 300 euros now. My future plan for 2024 is decrease savings to about 10k in about a span of a year. So that's about DCAing every month of saving 1k. Invest these in stocks, bonds, ETFs, and crypto. So, what is the exact income statement? You can see it as a profit and loss statement almost. It is. My income is about $700 because I'm a student. So this is my side job. And of that 700, I want to invest 200 in cryptocurrencies and 500 in individual stocks that I pick, like Alibaba, like an Alphabet, preferably Alphabet at the moment. I have about $1,000 in savings, as I said. Right, we were going to DCA 1K for every month of savings, and we're going to put that in exchange-traded funds, so the S&P 500 and the US Tech. Then I get dividends and a coupon, a little bit. The exact amount is of course not known, but this will be at most $100 a year, not more than that. So I'll just put that in ETFs and I'll see what happens to them. And I have a bit of other income, $800 or 800 euros. I'm gonna put that straight into the bonds because the bonds they make my portfolio very safe. That's basically the notion. I have a lot invested in cryptocurrencies and tech stocks and even in tech ETFs. So I want a bit of bonds, very safe government bonds. I don't think the Dutch government is going to collapse in the upcoming 15 years. So very safe government bonds. So that's kind of to balance or stabilize my my portfolio. So I'm not invested too heavily into tech and very risky assets. So the plan: good risk management with bonds. Aggressively invest in the technology sector, including cryptocurrencies, including US tech ETFs, including individual stocks. I'm more of a growth stock guy than a dividend value stock guy. Never really felt this charm for dividends. Some people get entirely grasped by the idea of dividends. I don't really have that, and I also think it's a bit of a ridiculous thing to do. You know, if all you do is look at dividends, eventually you kind of stop seeing the real value of innovative companies. And I think especially this year it became very obvious to most investors that innovative companies can be very, very lucrative. So that's why I'm more into growth stocks. Also, I'm a young lad. You know, I have about 40 to 50 years till retirement. I can have it. I can take the losses that growth stocks could potentially have. If I now currently lose all my money, it doesn't really matter in the end because I still have 40 years to build up enough capital to fund my retirement accounts. So I'm fine. So I can actually accept the risk, I can tolerate the risk of growth stocks in return for hopefully higher returns. Keep DCA in small amounts in BTC and Link, so that's about $200 every month, and follow a 50-50 ETF split, 50% in the S&P 500, which is kind of like the safe ETF part, and then 50% in US tech, which is kind of like the risky ETF part. So, why so heavy on tech? Well, these are the major reasons. Just look at the S&P 500 and the Nasdaq 100. Now, of course, I still see that I have my laser pointer over here. That's not good. I didn't mean to do that. But, and of course this is comparing, this comparison is a bit ludicrous, right? You can't really compare the past 5 years of Nasdaq 100 performance with the S&P 500 performance. It's just not fair, because all of us know that tech stocks did really well in the last 5 years, or heck, even the last decade. But I still want to show you that tech stocks are winning. If we just look at the last 20 years even, you know, after the internet bubble, tech stocks still outperformed other sector stocks. So if we just look at it, I'm a 20-year-old guy. For my entire life, tech stocks dominated the stock market. So why wouldn't I invest in tech stocks, especially when I'm young? You know, so, and also I'm personally of the opinion that tech stocks are actually going to continue dominating because they're so innovative. They're going to create the new technologies that are needed for, well, further progress in the general economy, right? With AI and cloud and what else they're doing in the tech sector now. So I'm of that opinion. If you say, okay, well, I don't really think that. I think I want to have more in traditional companies, then you can do the S&P 500, of course. But I personally think that tech sector will just continue to absolutely dominate, as it has done for the last 2 decades. Further reasons is because I have a general higher risk tolerance. You could have seen that, of course, with last year when I was heavily invested in Chainlink, which arguably wasn't that smart of an investment. But also because I'm young, I have a higher risk tolerance because my retirement age and all of the other things that old people do are just 40 to 50 years away. And there are no other really risky assets. Emerging markets, for example, haven't performed as well as the S&P 500, even all world index, and small cap hasn't either. If you just look at the index performance of emerging markets, you can kind of see here the MSCI emerging markets. In the last 10 years, there's annualized return of 2.5% compared to the MSCI World, which is a world index fund, which really is 60% almost. I think it's like 60% S&P 500 or like 60% US, so it's still heavily on the US, but it has about a 9 years annualized return. And the MSCI ACWI, which is the all country world index, is the 8.16%, so it's a bit less, but it's almost like the same fund. It's very much alike. So you can see that if you just look at the 10 years annualized return of the last decade, the emerging markets get absolutely wrecked on. It gets dominated. Since 1987, it is doing very well. If you just look at from the 1990s, it's better than the other two. But if from the last decade, it's worse. From the last 5 years, it's worse. From the last 3 years, it's worse. So just to grasp that idea, if you invested 3 years ago in an emerging markets ETF, you would have lost money. And in addition to actually losing money, you also have less buying power with that money because of inflation. So that's absolutely terrible. And in year to date, it's performing extremely bad. Last year, terrible. 3 months, well, almost the same, but it's terrible. 1 month, still bad. So just so you kind of understand, emerging markets aren't that interesting, just looking at previous performances. And in addition to that, as well, if you just look at it from a logical perspective, American companies are dominating the global economy, right? Because an Amazon can just go to different companies, start up an Amazon India or whatever, and just make a profit because they can offer the product for very, very cheap. And all the profit that gets made from those sales goes back to America. So if you just get the logical concept of monopolies and how that works, especially in this globalized economy, you would understand that, okay, well, American companies are going to dominate. They're currently dominating, and they're continuing to pretty much dominate the entire global economy. And I don't think that's going to change anytime soon. So that's why I'm not that interested in emerging markets. And then if we look at the small caps, the Russell 2000 index is, okay, yeah, sure, you're up 50%. But if we look back at that from the Nasdaq 100 and S&P 500, these are up 90% and 168% in the last 5 years. So the Russell 2000 is underperforming as well. Now also a lot of Russell 2000 index companies, small cap companies, are struggling with debt because they have a lot of zombie companies. So during these interest high times, for the people that don't know what zombie companies are companies that are basically living off of debt currently. They have so much debt they can barely make the interest payments, and as soon as those rise, they'll pretty much go bankrupt. So they're really struggling now. Just if you look at the, once again, monopoly idea, the large companies that have a monopoly can outperform and outcompete the smaller companies. So these Russell 2000 index companies only thrive in very niche markets that are just not interesting for the large corporation. But the problem with niche markets is that they don't have that much money in them. So it's not really that interesting. And all of this also kind of breaks down to having capital. You know, the reason these emerging markets are usually lacking is because they lack capital. The reason these smaller companies are lacking is because they lack capital. These very large corporations have a lot of capital. They can invest a lot of money in their people, in their machines, in their production, and that is why they can offer products cheaper, at better quality, with better qualities, and also invest more into innovation and get newer products, while these smaller companies are stuck with very, very old tech almost, and they can't really compete with the fast and better tech these large corporations have. And that capital is kind of the economics course of factors of production, where you first have land, labor, and I kind of switch these two around. Normally entrepreneurship is the last one, but capital, right? And this one is obviously geared towards countries, right? Land, labor, entrepreneurship, obviously countries. But if you just use the analogy with these companies, you could kind of understand that in companies, capital is also very important. And these smaller companies usually lack capital. And you could, of course, make a counter argument to that by saying, hey, okay, well, they lack capital, then why don't we provide them with capital? Well, the problem is we are small retail investors. We can't do that. You need billions of dollars to do that. So we can only play by the book, play by the rules, and just accept that we will have to be investing in the S&P 500 for the time being. So yeah, that is the reason why I won't invest in emerging markets and small cap ETFs, and I'm more interested in tech ETFs as a risky endeavor. Okay, now that's very... and now I explained my full reasoning behind it, and I hope most of you agree, or at least I hope now most of you understand why. Then I want to have a little bit of extra theory, and I want to do this with every video, so just so in the last part I can kind of share some theory with you guys that I read, and that's very interesting to know. because I think it's really fun. And I also kind of want to give the people that stay till the end a little treat, I guess. Nah, it's not a little treat, but a little thank you. And in return for that, I want to share some theory and some investing advice at least. So talking about the disposition effect, what is the disposition effect? And you see a lot of beginning investors do this, is where, as literally the analogy says, is cutting the flowers and watering the weeds. So they do. Okay, well this is by the way wrong. They cut this. Don't. Or well, this is the advice. Don't sell your winners to compensate for losers. That's kind of the advice that this disposition effect gives. So what does that mean is what you see a lot of beginning investors do is they'll have, let's say, two positions, right? One position is up 20%, the other one is down 20%. Which one are beginning investors going to sell? The one that is up 20%. And they're selling it because they want to compensate almost for the one that is down 20%. And that's just a complete fallacy. Why would you sell the one that's winning in return for one that's losing? Because now where you went from a stock portfolio that's 50-50 winners and losers, now you went to a stock portfolio that's 100% losers. So that's obviously not the reasoning you should use. If the stock is up 20% and your reasoning is, okay, well, it's plateaued, this is kind of like the ceiling that's gonna reach, then of course you have decent reasoning. But if all your reasoning is you need the capital or you want to sell it to realize the gains and to kind of compensate for the losers, then that's just terrible investment advice, or well, terrible investment actions. Not to mention you're going to pay taxes over realized gains, but whatever. So, in other words, don't sell your winners to compensate for the losers. And I think that's good advice for most beginning investors, because I was watching one portfolio video yesterday as well, and this lady had about 10 positions, I believe, of which 2 were in the green. Don't ask me how, but 2 were in the green. And she sold those 2 because they were in the green. And she kept all 8 other red ones. So that's just terrible action, because she didn't reason for this. She just said, well, those are in the green, so I want to realize those gains. And I just want to hold the red ones in hopes that they eventually return a positive value. Well, that's just terrible investment. At that point, you might as well just go to the casino, because you have better odds there. So that's the disposition effect. Don't sell your winners to compensate for losers. Okay? Don't cut the flowers to water the weeds. Alright? So just realize that next time you look at your portfolio and you're like, okay, should I sell my green position? Okay, go back to why did you invest in it? What do you think its value is? Do you still think it's undervalued? If it's still undervalued, just keep the position. Why would you sell it, right? So that, I think it's a very good thing to be wary of, I guess. So thank you all for watching. I still have my laser pointer here. Thank you all for watching, and I'll see you guys in the next video. And yeah, just thank you very much. And if you have any questions, if you have anything to comment, if you don't agree with my tech sector makeup or tech heavy portfolio, just leave it down below, and maybe we'll have a nice discussion, or maybe heck, you'll even convince me to stray away from the tech. I don't know, but we'll have to see. So thank you all for watching, and see you guys next video. Goodbye.